Hello, this is Calvin Andrassy, and now we're going to be talking about economic instability and ways in which governments can potentially intervene in trying to stabilize the economy. So there are two main approaches that governments undertake in an attempt to stabilize the government. The first being different types of fiscal policy, and the second being monetary policy. So let's focus first on fiscal policy here. So the ideas of a fiscal policy are to try to either stimulate economic growth in the case that the economy is moving too slowly, and hoping to try to expand the economy by improving the conditions to allow it to do so, or to potentially stabilize the economy in terms of pricing, as might be the case during a contractionary period where the economy isn't doing so hot, and inflation might be rearing its head. It tries to slow down the economy a little bit to make sure that prices don't become so significantly higher in each individual period that it affects the ability of the general public to be able to afford basic goods and services. Okay. Fiscal policy might also attempt to achieve full employment, and in some cases it may seek to try to improve the conditions of those individuals in the lower socioeconomic status by redistributing income in certain cases through things like transfer payments, borrowing, selling of securities, and things like that, in order to put money in the hands of individuals that have less of it, particularly when when it becomes difficult for individuals to be able to participate in market activities due to significant contractions in the market. Okay. In addition to the utilization of fiscal policies, there are also what we call economic multipliers that do tend to increase the effects, if you will, of fiscal policies. That includes things like government spending, taxes, general fiscal multipliers, and the marginal propensity to consume. And the idea behind these things is, things like government spending and taxes, they either speed up or slow down the economy as well. It puts more of a demand on certain, or rather increases the supply of certain goods and services in the case of government spending, where there's more money available for certain economic elements to be present. Taxes might slow down the economy by requiring more funding to go to the government instead of towards goods and services, thereby potentially decreasing the supply available or decreasing the demand in some cases, because the prices have either increased in value or have ultimately decreased in value. So there's lots of things that can kind of help to spur that along. So economic stabilizers are also parts of a government budget that offset some of the fluctuations that we tend to see in collective demand. So things like progressive and graduated personal and corporate income taxes, where you essentially pay more money in taxes if you are earning more money, and you pay less in taxes if you're earning less money in the market system. Transfer payments, like social welfare programs, that includes things like housing support, food assistance programs. Here in the United States, there's a lot of available government housing. There are things like food stamp programs that are basically used to inject the economy with a little bit of additional income, and it tends to counter some of the elements of the business cycle in doing so. Unemployment benefits are for those individuals that have lose their job, usually due to things like cyclical unemployment, so that their incomes can be supported and they can continue to spend, continue to contribute to the economy, lessening the impact of things like a recessionary period. And then, of course, we have in the United States, in particular, the Social Security system, which provides a number of benefits to retirees who can't earn an income, individuals with disabilities who can't earn an income, and then, of course, survivor benefits as well to individuals who have lost a loved one that were potentially, contributing to the household income, and that income is no longer going to be available to them. So Social Security is a system that is based on individual contributions over time. So the higher your wages the more you're going to be contributing into that system. The lower your wages, the lower your contributions are going to be in that case as well. Okay, so let's talk a little bit about deficits and the amount of debt that is accrued in different countries. Okay, so there is a distinction between a deficit and a debt, and in order to understand that, we have to understand the government budget and the budgeting cycle that is contributory to that. So the government budget is where you take all the revenues collected from taxes and other sources of income to the economy. There are some businesses that the government has a hand in, essentially, that it sells a service or a good, and it uses that money to fill its coffers. And basically, the budget, the government budget, is what establishes the amount of spending that the government can engage in. And of course, if government spending exceeds the revenues brought in from the taxes and other sources of income, that's when you have a budget deficit for that period. Okay, and those deficits are then financed through borrowing. That includes the sale of bonds, various bills, and other types of securities and financial instruments, so that the government can have the cash on hand to be able to purchase whatever goods and services that it is going to be utilizing and providing. And then it has to eventually pay back those loans or those financial instruments in order to eliminate that deficit. So basically, if the government does happen to run a deficit, it's going to require additional resources to come in from other sectors, and engages in what is known as net borrowing. Now, if it runs a surplus, which means that it has more money on hand than what it needs to operate, oftentimes it will lend money to other sectors, and that is what's called as net lending. Okay, debt, on the other hand, is the totality. It's the accumulation of borrowing plus the interest that is paid on whatever is borrowed. Okay, so we have external debt and we have domestic debt. External debt is going to be monies and interest that is due to entities outside of the United States. Domestic debt is money that is borrowed from within the United States, where, for an example, we have the sale of bonds. Anybody can go and purchase a bond, and there is going to be a maturity date where the government has to pay back the principal plus interest to the person who purchased that bond, and that's available within the United States in the case of U.S. budgeting, whereas the external debt is often owned by the governments in foreign countries, and occasionally, sometimes businesses in other countries might purchase the types of financial instruments that the government provides. So it's not entirely confined to the financial activities that take place domestically within the United States. Okay? And then there is the notion of a default, and that is when a debtor is unable to pay its financial obligations that are accrued from debt, so not being able to pay back the principal or the interest on what has been borrowed. And it's not necessarily uncommon for governments to default. Following the Great Recession, you did see quite a bit of government defaulting, especially in city governments and things like that. There are many local government entities, even in the United States, that within the last 20 years have defaulted on loans and unable to pay back the debt obligations that they had. So what happens with that usually is that their credit rating gets reduced, and it becomes a little bit more difficult for them to borrow money in the future. And in some cases, in the case of significant governmental collapse, as perhaps what we had during the Great Recession, you had countries like Ireland, Spain, and Greece that took pretty extraordinary steps to try to recover from their economic crises, implementing things like austerity measures where the government greatly reduced its spending, borrowing from the International Monetary Fund, and things like that. So those countries had varying degrees of success in being able to recover from that sort of thing, and it all depended on the kinds of actions that they took to try to recover from their default. Okay? And then comes the important notion of money, right? So money is a thing that just about everybody uses almost every day, at least as an adult. Even children are hopefully instilled as to the value of money. But money represents some sort of value, intrinsic value. It could be tied to a commodity. It could be tied to the public debt, but it represents the value usually of labor and of the growth of money essentially over time. So when you have commodity currencies, those are going to be linked to certain types of commodities. Gold has traditionally been a commodity to which money has been linked, silver, all sorts of different types of precious metals. But in some places, oil, food supplies, and things like that might be tied to the types of currencies that are used. And then we have fiat currencies. The United States dollar is an example of a fiat currency, where your currency is a legal tender. And its value stems from supply and demand and government stability. So if there is less of a if the economy isn't doing as well as it should be, essentially, if there's a little bit of instability, those currencies are going to be worth less money during those periods and worth more during expansionary periods and when the economy is stable. Okay? And then there are two other macroeconomic concepts that are of key importance. The velocity of money, which essentially takes, in this case, the GDP or really any quantity of goods that are produced multiplied by the price of those goods. So in the case of the GDP, we're talking about the total value of all goods and services produced in a country. So that, again, would be that quantity times the price. But in this case of all goods and services. And basically what you're doing is you're dividing that by the supply of money. So the greater the supply of money, the faster that money is going to be spent, and the less the supply of money available, the less and the slower it's going to be spent, right? If somebody doesn't have a lot of money, they're going to tend to budget more. They're going to try to save some of that money, and they're going to spend less of it over a period of time. The more money they have, the more free they'll be with the money and potentially spend that a little bit quicker. So that's the idea behind the velocity of money, which is very important in coming to understand, fiscal and monetary policies, because, supply and demand is intrinsically tied with the ability and the willingness of people to spend that money. So the faster people are spending that money, it means the more willing and able they're going to be to engage in the market. Okay? And then we have the flow of money, and that's the general types of ways that money is being spent. Okay? And that runs between consumers and firms. So what consumers do is they purchase goods and services. That's what's called consumer expenditure, and that money goes to the firms, which ultimately allows the firms to purchase the factors of production. And then firms, in turn, kind of cyclically give back to the consumers by paying wages, paying rents to individuals that own the land on which their businesses are, paying back dividends from the profits that they're generating. So money kind of circles and cycles in the economic system in this sort of way. Okay? Which brings us to the Federal Reserve Bank, which we talked about in a previous discussion a little bit. But the Federal Reserve is essentially the central bank. It controls the supply of money and the interest rates in the United States. The way it's structured is that there are 12 regional banks. This material being produced for Los Angeles Southwest College, the closest regional bank to Southwest College in the Los Angeles area is San Francisco, though there is a Federal Reserve satellite branch in downtown Los Angeles where you can take a tour and see them shredding old currency and things like that. Usually if you take that tour, they give you a little bag of shredded currency that's worth hundreds of dollars, but of course the currency is useless because it's all chopped up into little pieces. But I digress. The Federal Reserve is ultimately responsible for establishing, again, what we call monetary policy, where it's trying to control the amount of money that goes out into the system and becomes part of that circular flow model. Okay? So ultimately, it's responsible for supervising and regulating banks. It requires banks to have certain reserves, in the event that people want to withdraw their money. And it engages in review and regulation of the kinds of activities that banks are allowed to and not allowed to engage in. Okay? It also provides financial services to government banks. It does lend a lot of money and allow for money to be printed to go into the banks. It also establishes different types of money-related services, I guess we can say, to foreign institutions, including foreign banks, and oftentimes providing loans and whatnot to foreign governments in order to help them during periods in which they might be experiencing some financial hardships. Okay? So now let's get into the nitty-gritty of monetary policy. So it is when the government ultimately manages the money supply to promote price stability and full employment. So the kinds of activities that I mentioned the Fed engages in that allows for this to happen, setting reserve requirements for the banks so that they can hold that against deposit liabilities, so that if somebody comes in and wants their money, they have to have a certain amount of money available to make sure that those individuals can oftentimes get that money fairly readily in terms of cash, especially in the case of significant economic decline. We've seen things like runs on banks where people have tried to pull their money out of the banks because they have concerns that the banks are going to fail. The Federal Reserve establishing those reserve requirements is in part in place to ensure that those kinds of things don't have to happen. Banks can borrow reserves through the Federal Reserve's discount window at interest. So basically they're able to borrow money for a certain interest rate known as the discount rate. Or they can borrow money through the federal funds market at what we call the federal funds rate of interest. The Fed can also use open market operations in which they're going to be selling securities on the market, like treasury bonds and bills, again to bring money in, potentially slow down the economy, have less money available. With less money, it means that there is less of an ability and willingness of individuals to purchase goods and services, or in the case of borrowing money. If there's less money available, it makes interest rates go up a little bit higher, and people are going to be less likely to purchase major goods and services like houses or purchasing cars that they would otherwise borrow money for and use a loan to acquire or a mortgage to acquire. Things to kind of keep in mind. You've got the liquidity trap. That's when interest rates are low and savings become very high, where people are going to hold on to their money rather than necessarily spend it. Quantitative easing is something that is rather controversial, as it can potentially, it can be seen as sort of manipulating the market a little bit too much by some individuals. But that's when government maybe purchases back bonds, pushes up their prices, bringing down interest rates so that people can borrow more money in terms, and then in that case potentially have people pay more money for the bonds, and it results in a slowdown of the economy as well. And then, of course, there is a monetary policy relevant subsection of ways in which the government can potentially influence the economy, and that is supply side policies, oftentimes colloquially referred to either as Reaganomics or trickle-down economics. And that's when there is an increase in the supply of goods and services and activities taking place to try to maximize the supply of goods and services through things like tax cuts, deregulation of industries, so it makes it easier for them to produce goods and services, incentivizing investments, reforming the labor market, reducing the minimum wage as an example, making it easier to terminate employees. This gives power in the hands of producers, and the idea there is that that additional wealth that is being generated by those producers is going to trickle down again into the circular flow model and eventually get into the hands of consumers. The idea being that if you're a producer and you have this additional money, you're going to be more likely to be willing and able to produce the goods and services that you do in greater quantities. That's going to require you to hire more people to be on staff, and those people are going to get more money. They'll be then able to demand goods and services, have the ability and the willingness to purchase those goods and services, and it's going to be a back and forth. Of course, there are some criticisms of this because, as far as the obligations that businesses have with regard to public trading and things like that, it doesn't always work out that they're going to reinvest the additional funds that they're getting from these tax cuts and things like that, but rather distribute that as profits to their investors, based on their fiduciary duty. So, there are ways in which, there are valid criticisms that this approach does not work as effectively as it might be suggested, and it's generally going to be a bit of a political divide between economic liberals and economic progressives. Economic liberals being the more conservative in this particular case. Okay, so generally favored by the more conservative side, essentially, for these kinds of supply side policies. Okay, so let's talk a little bit then about the limits of what you can do with government intervention, and perhaps some of the reasons why you might be hesitant to engage in fiscal or monetary policy. Okay, so the government might not always be able to do what it sets out to do with these kinds of policies, and with programs that are intended to help the economy. And again, there's a lot of reasons why. So first and foremost, resource constraints, right? There aren't necessarily resources available for these kinds of programs, and the fewer the resources available, the less effective they're going to be. Kind of in addition to that, just because you're providing money to these sorts of programs doesn't necessarily mean that the effect that the programs are intended, and the policies as well that are intended to take place are necessarily going to take place within the time frame of the specific economic downturn or crisis that is present. It does take a little bit of time for these things to kind of go into effect. And in some cases, there are some concerns that, it's too little too late, and you're, contributing to deficits and the debt by engaging in these sorts of programs, and that's going to leave less resources available to you in the future to deal with more major problems that might come around. So, that is a valid concern about the employment of these sorts of policies. There are, of course, political considerations, right? Short-term losses for long-term gains might not be potentially popular for individuals that are holding office, right? Asking people to take an immediate blow for something that will benefit them years down the line is not the way that most politicians think, because they're more interested in getting elected in the next election cycle. So anything that is going to result in even if it's a short-term negative impact on the voting populace might not necessarily be the most popular and lead to them getting elected. Bureaucratic inefficiency is another problem. Bureaucracies are slow by design, right? They are there to make sure that the whim and fancy of, public sentiment doesn't immediately go into effect without, stopping and sitting down and considering and meshing out all the details before it happens. So, as I kind of mentioned with the resource constraints, there could be a potential time lag in the effect of policies. And like I said, it could be too little too late, or, too much being thrown at something that's no longer a problem, that has kind of rectified itself through the market. The burden of regulations. So there are many regulations out there that can potentially hinder firms, reduce market efficiency. Regulations are basically government's way of saying, hey, don't do that or else you're going to get punished. So businesses aren't going to be able to take certain steps, which will slow the ability of them to utilize any resources made available to them through fiscal or monetary policies. So it might not necessarily result in the most efficient use of those resources. And then, of course, corruption and cronyism. So there are lots of concerns, even in the United States, of the potential for corruption and cronyism, basically taking those resources from fiscal and monetary policies and contributing them to individuals on the basis of political favoritism, and that could potentially be problematic, right? Los Angeles Southwest College, for example, in California, there are a lot of concerns about policies and programs that have been allocated in the state of California, that there are concerns that the government has not allocated those resources as they should. In terms of wealth redistribution programs, especially for the homeless, there are billions of dollars that essentially went missing in the early 2000s that are unaccounted for. I'm not saying that that's necessarily corruption, but entirely possible that that corruption could have potentially played a part in that. There are certain places in the United States that have had a history of corruption and cronyism in the past. Just the general idea that ultimately it's humans that run government, and there's no guarantee that humans are going to do the right thing, even in a sacred position with certain duties. There are always going to be concerns that monies allocated in such a way can be misappropriated, misallocated, and not used for the purposes that they are intended, but instead used to benefit either the politicians directly or those individuals with close ties to them. Okay, so those are some of the kinds of economic issues that can arise and ways in which the U.S. government deals with them, and that is a large part of the discussion that takes place in macroeconomics. Moving on from here, we're going to be continuing to look at the health and ways in which you're trying to make predictions about the way that the economy is ultimately going to be playing out in a designated period, and that again contributes to the need for these kinds of fiscal and monetary programs to potentially be implemented, and sitting down and thinking about the situations under which these kinds of policies and programs are going to be necessary, and whether it might be better to allow the economy to try to rectify itself under classical economic theoretical lenses. It's all a balancing act. It's walking a tightrope, essentially, between potentially leaning too far one way or leaning too far to the other way, and having more problems than the problem at hand potentially is contributing to. So in that sense, when we talk about the government and its role in the economy, this is ultimately the kinds of decisions that different individuals are going to have to be making. And as I mentioned, there's a political element to it. and differing perspectives on what is appropriate to do under certain circumstances. And that's what a lot of macroeconomists are all about, trying to determine when is the most appropriate time to take what kinds of actions, given the circumstances that are present.